Hey guys, welcome back to Smart Wallet and Me, where financial wisdom really matters. Today I'm going to be talking about 3 stock valuation methods to pick for growing dividend stocks. I know that a lot of people are investing in these new dividend paying stocks because we're living in a very low interest rate environment, and a lot of people are trying to get more value from their money by investing it in stocks that pay out dividends on a monthly or quarterly basis. So I figured that I wanted to give you guys some idea of what to look for whenever you invest in dividend stocks. So the 3 things that I look at whenever I invest in stocks that pay out dividends is: number 1, I'm looking at a 5-year growth rate. Number 2, I'm looking at the payout ratio. And number 3, I'm looking at the debt that the company holds. So in this example, I'm looking at General Mills, and we can see here that the dividend yield is 3.25%. I know that a lot of people just look at this number and they don't look at anything else because they see that if this number is 3% or 2% or even 10%, they immediately think that it's a very good paying stock. It's a very good dividend paying stock. However, you need to also consider these other things that I'm going to be talking about right now. So number 1, you want to look at the 5-year growth rate. In this case, you can see that this stock is paying a dividend yield of 3.25% or an annual payout of $2.04, which has a 5-year growth rate of 4.01%. And the second thing you want to look at is the payout ratio, which is 56.2%. A good rule of thumb is to focus on stocks with payout ratios of 60% or below. Why, might you ask? It's because this payout level leaves enough breathing room for the underlying company, meaning that there's enough money left to buy back shares or increase the dividend and to reinvest in the business or anything else that could move the needle. So in other words, that you don't want this to be too high and you don't want this number to be too low, because you want the company to be able to pay the dividend and be healthy enough so that they're investing the money back, and also they are solvent enough to be able to pay their investors. The other thing that you want to look at here is the 5-year growth rate. You want to make sure that the growth rate is a healthy growth rate. You want to make sure that it's at least producing 3 to 4 and even higher, because the higher the growth rate is, the better the company is and the more money that you're going to get back. And the other thing is you want to make sure that the company doesn't have a lot of debt. Like for example, AT&T, they have a very high yielding percentage here of 7.5%. However, their 5-year growth rate is only 2.09%, which is very low. They're not really going to grow that much. And their payout ratio is 65%, which is slightly higher than that 60% that we just spoke about. And they pay on a quarterly basis, and they pay $2.08. Yes, AT&T is a very solid company, and it is an aristocrat. I have no problem with that. I have in fact invested in AT&T. However, whenever you're thinking about investing, you want to make sure you look at these other ratios and other numbers as well, and not just the dividend yield. Because if the company is not growing their dividends, you can see that in this particular situation, their 5-year growth rate is only 2.09%. And for the 10-year growth rate, it's only 2.21%. So you're not really going to get that much growth in this company regarding the dividends is concerned. I'm not talking about the capital of the stock going up, but I'm just talking about mainly the dividend growth rate here. Also, remember that AT&T has a huge debt crisis right now. If you look at their total debt, their balance sheet, you can see that their total debt right now is $184 million compared to $123 million in 2016. So in 4 years, their debt really went up tremendously. So that's another thing that you want to take into consideration whenever you start investing in a company, because whenever you have a high dividend yield and a high debt, then that means that the competitiveness and the risk of this company will impact the performance in the coming years. And if earnings start to dip while debt remains high, something's got to give, and chances are that it will be the current fat payout, which would be the dividend yield. So if you're really relying on that dividend yield of this 7.5%, if you're in retirement or something, and all of a sudden you see that the debt is taking its toll, this number is going to have to give, and it's going to come down. So you want to make sure you look at that, and you want to make sure you look at the 5-year growth rate to see how much the company is going to be growing within the next 5 years. Yeah, that's something to take into consideration when you're making these investments. So guys, if you like this video, please give me a thumbs up, subscribe to my channel. I'll be making more videos like this. Thanks for watching.